Hello, and welcome to the third installment of our quarterly compliance webinar series. My name is Brad Stumpy. I'm a partner and the practice leader for financial institution compliance and loan review services at Anders. I'll be joined today by Sadie Carrera, a compliance supervisor who specializes in loan compliance. I'd like to start by sending out a congratulatory shout to Sadie. Those of you who joined us for our last webinar on flood insurance may know her better as Hurricane Sadie, but she recently passed her CRCM exam, so we're very proud of her for that accomplishment. For those of you who participated in the live webinar, you know that we had some technical difficulties in that my connectivity was less than stable, which meant that Sadie had to jump in and present several of the slides that I had prepared for and that she had not. So a big thank you to her for doing that. We decided to re-record the webinar to remove the distraction of my dropping off, popping back in for a couple minutes, then dropping off again, and repeating that cycle. So you may notice a few differences. At the conclusion of our last webinar, we asked what topics you'd like to see in future presentations, and the winner was, drumroll please, in a close race with fair lending, TRID. Since we had already covered a fair lending topic in 1071 earlier this year, and since the final CRA modernization reg had not yet been published, we had to begin publicizing this webinar, we went with TRID. So let's go ahead and advance the slides while I ramble on. My apologies for making you stare at my picture for so long. Speaking of the CRA reg, we've published a blog with our initial high-level summary. So when we're done here, you can head on over to our website and take a look if you're so inclined. Hopefully we don't find out that we're way off base as we dig deeper into the nearly 1,500-page document that was released a couple weeks ago, but we gave it our best initial shot. For those of you who are interested in CRA, we'll have more coming out on that in the not too distant future. We're not sure yet if that will be in the form of a webinar, a series of videos that focus on specific aspects of the rule, or something else. But everyone who's registered for this session will be on the distribution list announcing the availability of that material, so keep your eyes open. As with our previous webinars, I'll kick things off, hand it over to Sadie about the time I think you're getting tired of my voice, and then I'll circle back to close things out. So we'll go ahead and wave goodbye to Sadie for now. All right, so back to the program. With a little less than an hour as it currently stands, we are not going to cover the intricacies of the TRID rules, but rather we want to go over some of the common mistakes we see with the content and timing of loan estimates, service provider lists, and closing disclosures, and focusing on those that result in tolerance cures, which essentially means reimbursements. With any luck, by focusing on those, you can minimize, heck, hopefully eliminate reimbursements. You can avoid technical errors and come away from your next exam with a glowing report. Just like 1071, the TRID rules were born out of the 2008 housing crisis and the Dodd-Frank Act. Unlike with 1071, the TRID rules were published in a reasonably timely manner, and we're coming up on the 10-year anniversary of when the final rules were published, so happy early anniversary, TRID, but there have been several amendments and clarifications along the way. I think everyone is aware that TRID spelled backwards is dirt, and that is the easiest way to remember which loans have to comply with TRID rules. If it's closed-end, consumer purpose, and secured by dirt, then TRID probably applies. We have a big media wall in our office, and this webinar was advertised on that wall for a couple of weeks leading up to the live presentation. And the most common question I receive from those non-banking accountants in our office is, Brad, what does TRID stand for? When I told them that it is short for Truth in Lending and Real Estate Settlement Procedures, Integrated Disclosures, their eyes glossed over. When I further explained that it combined different disclosures required by multiple rules into a unified set of disclosures, their eyes rolled back into their heads, and I don't think too many of them signed up. But that's okay. We had all of our favorite people with us online and now with this recorded version. While the rules are very tedious about how the disclosures must be completed, the LEs we see today are much more uniform than the good faith estimates from the good old days, if you remember those. And from a consumer protection standpoint, in my mind, the most impactful change was that the rule holds you, the lender, to the fees disclosed on the loan estimate within certain tolerances. So this slide simply lists the 5 areas that we'll cover today to give you a sense of the order of the presentation. Because I tend to ramble, have you noticed? And since Sadie just passed her CRCM, so all of these details should be fresh in her mind, I'll cover about the first bullet point and a half, and then she'll cover the rest. It seemed like a very fair deal to me. Start off with the timing requirements for the loan estimate. There are 6 items that constitute an application in so much as it starts the clock for providing the loan estimate. And then this slide, the next slide, please. So this one includes all 6 items that constitute an application. In addition to name, income, and property address, there's also loan amount, property value, and social security number so that you can obtain a credit report. So these 6 pieces of information count if they were submitted in a written, electronic, or verbal application. Basically, if in some shape or form they request or apply for a covered loan and communicate these 6 items, then you have an application and need to start thinking about getting an LE out the door. Keep in mind that this information does not have to be verified. As long as the applicant has provided you with an amount for income, an estimate of the property value, and how much they want to borrow, then the 3-day clock starts ticking to provide the loan estimate. The official interpretations to Reg Z go so far as to say that a creditor cannot explicitly or implicitly represent to the consumer that an LE will not be provided until verifying documentation is obtained. So, what if this information is correct? They told you something crazy and it impacts what was disclosed on the LE. If you find that out as you underwrite the loan, it's a changed circumstance and you can redisclose. Sadie will get into various scenarios that constitute changed circumstances later. Just know that you do have the opportunity to adjust the disclosed amounts if what the applicant told you ends up being incorrect and that incorrect data impacts the disclosures. So nothing prevents you from asking for additional information. We all know that there's a lot more than these 6 items on the standard app. Ask all you want. You just can't delay the LE based on anything other than these 6 items. One of the examples that the CFPB has given is that you cannot require the sales contract. You can ask for it. Hey, Brad, can you send the sales contract our way when you get a chance? What you can't do is hold up the LE or imply that you will. So the timing requirements of the loan estimate have 2 different criteria. The first criteria, as we alluded to earlier, is that you have 3 business days to deliver the loan estimate once the 6 elements we just discussed have been received. So this seems pretty straightforward, and usually it is. One place it can get confusing is with construction loans, particularly if you have 2 closings, one for the construction phase and another for the permanent phase, but you only have 1 application that covers both phases. In this situation, you want to issue 2 separate loan estimates, one for each phase. And on the permanent phase LE, clearly and conspicuously state that a revised disclosure may be provided at any time prior to 60 days before consummation. If you include such a statement, you may revise the permanent phase LE without a changed circumstance at any time until you hit that 60-day window leading up to closing. The second criteria is that the LE must be delivered at least 7 business days prior to consummation. So you have to hurry up and get the LE out within 3 days of application, but then make sure you don't get into too much of a hurry because you can't close a loan for at least 7 days after you deliver the loan estimate. So it's a lot like many things in life. Hurry up and wait. My family often has a distinct pleasure of previewing my presentations. They don't call it a distinct pleasure. But after a recent preview, my teenage daughter told me that I should throw in some fun facts to help keep everyone's attention. So here is my fun fact, or as I might describe it, important to know. The 7-day waiting period prior to consummation only applies for the initial loan estimate and does not apply to any revised LEs that you issue after the initial disclosure. So when you reissue an LE for a changed circumstance, the 7-day clock does not reset. It keeps ticking from the initial LE. Those of you who have been doing compliance long enough know to pay close attention to whether timing requirements are based on calendar days or business days. And if it is business days, you also know to look up the definition of business day for that particular requirement. We all know that this definition can change from regulation to regulation. But in the case of LE timing requirements, they threw us a real curveball and included a special definition of business day just for LEs that differs from the definition of a business day throughout the rest of Reg Z. It's even different than the definition to determine the timeliness of your closing disclosure and the rescission period. So you have to be familiar with multiple definitions of a business day for a single transaction. Thanks a lot, CFPB. So, what does it mean to be open for substantially all business purposes? The example in the official interpretation states that if the only services available are deposits, withdrawals, bill pay, and related services, then you are not open for substantially all business purposes, and that day does not count for your 3 business day test. On the other hand, if you can make loan disbursements, open new accounts, handle credit transaction inquiries, then you are open for substantially all business purposes, and that day does count for your 3 business day test. For the 7-day before consummation and pretty much all other related requirements, you use the more specific definition of every day except Sundays and federal holidays. Oh, we also get the question from time to time about waiving this 7-day period. And similar to rescission, it can be waived for a bona fide personal financial emergency. The process is a little different than it is for rescission, and this slide discusses the elements that must be present to waive the 7 business day waiting period after receiving the LE. The example given for a bona fide financial personal emergency continues to be the imminent sale of the consumer's home at foreclosure, where the foreclosure will happen unless loan proceeds are made available during the waiting period. As an example, it's not exclusive, but it does give us an idea of the standard that must be met. The borrowers are in danger of losing their home. Generally, to meet a contract deadline has not been considered a bona fide financial emergency. Also of note is that the creditor may not provide the consumer with a pre-printed waiver form. The borrowers have to come up with that themselves. We do get asked about this from time to time, the 7-day waiver, but I don't know that I've ever seen that that 7-day waiting period was actually waived. If you either receive mortgage applications from a broker or you broker mortgage applications to another lender, then this slide outlines some of the basic rules surrounding those relationships. The broker may provide the loan estimate on the creditor's behalf, but keep in mind that if you do have a broker providing LEs on your behalf, that you are expected to have processes in place to ensure the LE and its delivery satisfy all the timing and content requirements, since you, as the creditor, are responsible for any errors or defects. So that pretty much does it for the provision rules. But before we jump to the next section on content, I wanted to make one comment about an issue we run into from time to time in delivering the LE. In the way back times, this usually meant that we physically handed the disclosure to someone in person, or maybe dropped it in the mail if they couldn't make it by the bank in time. In current times, it more often involves emailing the disclosure, or otherwise providing it in an electronic format. The LE is one of those disclosures that must be provided in an e-sign compliant manner. And I know that jumping through all the e-sign hoops in 3 days can be difficult. Please be sure you've done so before relying on electronic methods as the sole means of delivering the LE. If you haven't been able to jump through all of those hoops, just drop it in the mail by day 3 as a CYA measure. It says you can't also provide the LE electronically, but by also dropping it in the mail, if all the upfront e-sign steps have not been completed, you've covered all your bases. All right, so now on to content. Or I guess content intolerance. So we all know that the instructions for completing the LE are beyond picky. The primary purpose behind that was to standardize the form so that when consumers applied with multiple lenders, to truly shop, they can come as close to comparing apples to apples as possible. Many of the errors we see regarding the content of LEs are simply technical violations and do not result in tolerance cures. But if there are too many of those technical errors, not only can examiners point to it as a weakness in your system, but it increases the chance that one or more of those technical errors do result in a reimbursement. So throughout the text of the regulation and the related guidance, you'll see reference to the good faith standard or a phrase such as completed in good faith. I wish they would have found a different term because I hate telling people that something wasn't done in good faith. It sounds like they weren't being honest, and I rarely think someone isn't being honest. They just didn't know the ins and outs of the rule. From a TRID perspective, what does good faith mean? The official interpretations discuss exercising due diligence to obtain information that is reasonably available at the time of issuance. Examples given include obtaining information from the applicant, from insurance companies, and from realtors. This is not an exhaustive list. I'd also include publicly available information such as government websites, think property taxes, in the mix as a possibility as well. If you charge the borrower less than was disclosed, that is not going to be a good faith concern from a tolerance perspective. However, if you charge the borrower more than was disclosed, then you will need to determine which tolerance bucket the fee is in. When you're making that determination, whether the amount on the LE was disclosed to the good faith standard could play into which tolerance category will apply. When the good faith requirement is not met, the charge imposed on the consumer at consummation may not exceed the amount originally disclosed for that item. If no loan estimate was provided, then the good faith standard was not met and all closing costs would be considered a tolerance cure. For some loans, that number can be substantial. And we don't see this often, but when we do, it's typically when someone reverts to the old, good faith estimate rules and says, well, there was no dwelling on the property, so I didn't think TRID applied. Or maybe when a consumer loan is processed as a commercial loan, so no LE is provided. I think that sometimes this is due to a misunderstanding, and other times the envelope might get pushed just a little bit to avoid the 7-day waiting period, the ATR rules, or TRID disclosures in general. So regardless of the reason, a missing LE is bad news. We've also included untimely disclosures on this slide. We've heard the argument made from the context of, to be in good faith, the disclosures had to be made pursuant to section 1026.19E as an echo of Regulation Z. And if the LE was not timely, then it wasn't made pursuant to that section. While we've heard of this argument being made, knock on wood, I can't recall seeing it being used. But why take the chance? If the LE is a day or two late for a loan that takes a month to close, I doubt anyone will call that more than a technical exception. But the later the LE is, and in my mind, better late than never, the more likely someone could come to making that argument. So the next 3 slides cover the different tolerance buckets. Zero tolerance, where no increases can happen. 10% tolerance, which is an aggregate or cumulative tolerance bucket. And no tolerance, which means that there is no tolerance limits so long as the estimate was disclosed in good faith. Slide includes those items for which there is zero tolerance. No individual fee in this category can increase beyond what was disclosed on the LE unless there's a triggering event, such as a changed circumstance, that allows for a revised LE. So this is going to be any fees that are paid to the creditor, to a mortgage broker, or to an affiliate of either the creditor or the mortgage broker. It's also going to be origination charges, such as your points, and by that we mean discount points, which we're starting to see more of. Your underwriting fees, application fees, a loan level price adjustment that's passed on to the borrower, things of that nature. Transfer taxes and those lender required services that the applicant is not allowed to shop for. You'll find a lot of those in section B on page 2 of the LE. Think appraisal fee, credit report fee, flood determination fee, an HOA cert fee, third-party subordination fees, and I could go on, but I won't. These are also in the zero tolerance bucket. Finally, you have those fees not disclosed in good faith. This would be those charges for which someone, an examiner, an auditor, an opposing attorney, contends that there's insufficient evidence to support that you exercised due diligence to obtain information that was reasonably LE was issued, and technical errors, miscalculations, underestimations are not valid reasons for under disclosure. This slide covers those fees that can increase by up to 10% in the aggregate. Essentially, it includes recording fees and charges for third-party services, not servicers. So essentially, this includes recording fees and charges for third-party services required by the creditor that are not paid to the creditor or to an affiliate of the creditor, and for which the borrower is allowed to shop. But remember, if a fee is paid to the creditor or the creditor's affiliate, it's a zero tolerance item. So recording fees and services listed in section C of the LE, such as title fees and other services like inspections or surveys that you require for that particular loan, fall into the 10% bucket. Many of these are the services that you will include on your service provider list, or SPL, that Sadie will cover later. If the borrower chooses a provider from the service provider list that you furnish to them, then that fee is included in the 10% bucket. If they choose a provider that is not on your list, then there are no tolerance limitations for that particular fee, so long as it meets the good faith standard. If a untimely or incomplete service provider list appears to have prevented the consumer from shopping, then these fees are subject to the zero tolerance standard. If the service provider list is not provided as untimely or is incomplete, but it is still evident that the borrower was allowed to shop, then these fees can be included in the 10% bucket. Those are not automatically considered a good faith exception, but you will need to support your position as to why they are not. So how do you do that? These are just some ideas. It doesn't give you any guidance. If the SPL is missing, perhaps there's correspondence in the file that indicates there was shopping, or perhaps the service providers that is not typically used is selected. If the SPL is late, how late it is could impact that decision. If the SPL is incomplete, and I would say that a partial name of a provider where you can still figure out who it is and that has an address and a phone number is less problematic than a service provider that is not addressed on the SPL. And then you have everything in between. Questions come up from time to time about 10% fees that are missing from the LE, or the reverse scenario where 10% fees were on the LE but were not charged at closing. So first, fees that are missing from the LE. That is not a problem as long as aggregate 10% fees on the CD remain within 10% of what was disclosed on the LE. So second, the reverse of that. When a 10% fee is included on the LE but not charged at closing, then that fee must be removed from the calculation. So if you have $1,000 worth of 10% fees on the LE, and one of those fees for $100 is not charged to the consumer at consummation, Then you take 110% of $900 to determine your cumulative limit for fees in the 10% bucket on the closing disclosure. Hopefully that math makes sense without seeing it on the slide. All right. This slide lists those fees which are not subject to tolerance limitations so long as they meet the good faith standard. So pretty much, if we haven't talked about them yet, this is where they land. If they do not meet the good faith standard, then they become a zero tolerance fee and cannot increase above what was disclosed on the LE. We'll get some examples as we work through the next several slides that cover the more common errors we see when completing loan estimates. And we'll also discuss the tolerance cure implications for each. Luckily, several of them are just technical errors and don't have any direct impact on fees. With this, we'll essentially work our way through an LE from front to back. The first common error deals with the loan purpose at the top of page 1 and does not have a tolerance implication. If you're going to have a mistake, this is the kind you want to have. This may sound a bit HMDA-esque to those of you who are responsible for HMDA data, but we often see what should be described as a home equity loan disclosed as a refinance. A refinance is when an existing obligation that is secured by the subject property will be satisfied and replaced by the subject loan. That existing obligation that is satisfied and replaced can be either with your institution or with another lender. A home equity is when the loan does not meet the definition of a purchase, refinance, or construction loan, and that's initial construction. These are generally going to be your complete cash out refinances to pay for a wedding, or a divorce, education, credit card debt, you name it. Could also be where you're using your primary residence as collateral to pay off a loan secured by your vacation home if you're not also paying off a loan secured by your primary. But that might be getting a little too far down in the weeds. Next culprit on our list is the closing cost expiration date, which is in the indented paragraph right below the rate lock information at the top of page 1. This needs to be at least 10 business days from the date of the initial loan estimate. And these are the everyday except Sunday or federal holiday business days. This has to be an exact date. So November 8th, 2023, and not a statement such as the estimated closing cost expires on the 10th business day. Once in a while, we'll see a date that represents 10 calendar days rather than business days. But more often, we'll see a date included in this field on a reissued LE after the borrower has expressed an intent to proceed. So assuming they express that intent before the expiration date listed on the initial LE, this field should be left blank on all reissued loan estimates after the borrower has expressed an intent to proceed. You don't want them to think there's anything they need to do to lock in those costs or be confused by a date that is in the past. This is also where you see all the hoopla that we just went through about being sure you have the correct time zone. Is it standard time or daylight savings time? I understand the need to have the time zone, but that semi-annual fire drill drives me nuts. Enough on the closing cost expiration date. Again, no tolerance implications with this error. We're still on page 1 of the LE with this one, but we've dropped down to the last row of the projected payments table near the bottom of the page. Oftentimes for vacant land, we'll see this disclosed as $0. Perhaps there's no insurance or other assessments associated with the partial vacant land, but there should still be property taxes. The other common error is that if you're aware of construction or other improvements that will be made to the property during the first year of the loan, and that's whether or not those improvements will be funded using loan proceeds, then this number should be prospective. So estimating what these amounts will be on an as completed basis. While this disclosed amount, it's still on page 1, and the tolerance considerations really start to kick in on page 2. So again, no tolerance implications with this one. So all right, let's move into section A, origination charges at the top of page 2. Points are a zero tolerance item, and these are for each individual fee, not an aggregate amount. What should be disclosed as points in this section of the LE are what is commonly referred to as discount points. The borrower is buying down the rate, and these must be disclosed percentage of the loan and as a dollar amount. If no such fee is being paid, then the points line of the loan estimate should be left blank. For other charges that are sometimes referred to as points, but that don't buy down the interest rate, you need to find another term that meets the clear and conspicuous standard under Reg Z. Origination fee might be an option, but it doesn't have to be that. Here is that you call something points that does not meet the definition of points in this section of Reg Z. And since this zero tolerance section of the LE is on a fee by fee basis and not an aggregate basis, if you call it a point, and it should be an origination fee or whatever else you want to call it, then you could have a conversation on your hands about whether you can actually charge that fee at closing, or retrospectively, whether you need to issue a corrected CD and make reimbursement after closing. Right. So this next slide doesn't deal with one specific fee, but rather addresses those instances in which fees show up on the LE that are not charged to the borrower at consummation. We touched on this briefly a few minutes ago. If these happen to be 10% aggregate bucket fees, then they need to be removed from that bucket before you calculate your tolerances on the closing disclosure. We most commonly see this when a creditor includes any potential fee on the LE because they don't want to get caught not disclosing the fee and then not being able to charge for it. So perhaps you sell a lot of fixed rate loans in the secondary market, or at least you used to. So your default LE includes all of those fees that will be charged for a loan that will be sold. But the application in front of you is for an ARM, and you keep ARMs in your portfolio and will not be charging a tax transcript or a VOA fee. Then there's no need to include the tax transcript and VOA fees on the LE. If you do, then back them out before calculating your 10% tolerance levels. Perhaps you do significant business in rural areas, so it's not uncommon to have a house on septic. By default, you include a septic inspection on all of your LEs. So if the application in front of you is for a house in town where there's a public sewer system, then there's no need to include that fee on the LE. And if you do, then back it out if it ends up in the 10% bucket. Slide covers what may be the most common mistake we see on the LE, and it generally applies to home purchase loans. When the borrower will be purchasing the required lender's title policy and the optional owner's title policy simultaneously, the discount that is received for the simultaneous purchase of both policies should be applied to the optional owner's policy, even if the invoice you receive from the title company applies a discount to the lender's policy. So maybe you're a common sense, bottom line kind of person, and your reaction is, thanks, Brad, good to know, and I'll start doing it that way going forward. But in the end, the borrower is paying the same amount, so it's just another one of those nitpicky compliance rules. But since we're dealing with compliance here, sometimes you have to amp up your common sense into compliance sense. So where this usually impacts tolerance calculations is when the borrower chooses the title company listed on your service provider list. And I know that may not be as common for purchase transactions. They may be more likely to use whoever the realtor recommends. But when they do use the provider on your SPL, the lender's title insurance premium is part of the 10% aggregate bucket. You've now understated a charge in that 10% bucket. So when you go to calculate your tolerance at closing, it's lower than it could have been had you correctly applied the discount to the owner's policy rather than the lender's policy. So this is one of those occasions where doing it right actually helps you. Now bear with me on this next thought. To date, we've only seen this treated as a technical exception, but have tossed around a couple of ideas internally about how it could potentially be considered a tolerance cure. Could the discounted lender's premium be considered not in good faith, so the increase to the non-discounted premium would not be allowed at closing? Or Could the day come when you would need to compare a 10% bucket with a discounted lender's policy from the LE to a 10% bucket on the CD using a non-discounted lender's policy? We haven't seen examiners take it to this level, and I don't want to be an alarmist, but I think we've all seen what has been a common practice for a long time mushroom overnight into a reimbursable situation recently, and this is an easy one to avoid. Hopefully common sense prevails in this instance, and since the total title insurance premiums being paid by the borrower do not change, no one will go down that rabbit hole. One more slide on the simultaneous purchase of title insurance policies. This one includes the calculation from the reg for getting to the owner's title policy premium that should be disclosed when the invoice shows the discount as being applied to the lender's policy rather than the owner's policy. It is not rocket science, and I think most of you could figure it out without this formula, but thought we would share so you can see the arithmetic if you would like. All right, so hang in there. You're almost done with me and on to Sadie. I think I only have maybe 3 more slides to cover. The issue we sometimes see with recording fees is that the fee disclosed does not take into account information we see in the file that appears to have been available at the time the LE was issued, and that also indicates there will be additional recording fees. So maybe this was on title work, maybe something on the application, something in correspondence, but something indicates that there are issues with the title that are going to necessitate higher than normal recording fees. Be sure that these are addressed either on the initial LE or, if you find out later, on a reissued LE if necessary, because they'll impact the 10% bucket. Maybe by themselves, they won't make that bucket spill over. But if there are a couple of other charges that come in a little higher, in total, they could result in a tolerance cure. Up next is prepaids. The issues we usually see with prepaids is that the amounts disclosed do not meet the good faith standard, and by not doing so, they get slotted into the zero tolerance category. Sometimes this has to do with a complete omission of a fee. It could be an oversight. I don't know what's wrong with me. I had a brain lapse and completely forgot to, I don't know, pick your error. Maybe the homeowner's insurance amount was unreasonably low. Maybe there's information in the file that indicates mortgage insurance was required, but we left it out for some reason. Perhaps the wrong number of months was used when we had a presumed closing date. There could be any number of reasons, but if the information on the LE doesn't match information in the file, then the LE is considered not to be completed in good faith, and unfortunately, we go to the fee-by-fee zero tolerance bucket. The same concept applies for the initial escrow payment disclosures on the next slide. So you can see here a lot of the same items and concepts as with prepaids. And this pretty much wraps up my portion of the presentation. Yay! I'll hand it over to Sadie now to cover change circumstances, the service provider list, the timing and content of closing disclosures, and some issues with calculating the APR and finance charge for adjustable rate mortgages. After that, I'll circle back at the end to wrap things up. So thanks for bearing with me, everyone. And Sadie, it's all yours.
Thank you, Brad. Good day, everyone. Thank you again for joining us for this recording. I'm Sadie Carrera, a compliance supervisor with Anders CPAs and Advisors. Brad covered a lot of information regarding the loan estimate, timing and errors, and implications of tolerance cures. And as Brad just mentioned, I'm going to go over change of circumstance, the service provider list, some timing requirements of the closing disclosure and redisclosure, as well as a few commonly identified errors or issues that can arise when preparing the closing disclosure. So let's begin with the change of circumstance. As you can see, this slide explains the definition of a change of circumstance: an extraordinary event beyond the control of any interested party or other unexpected event specific to the consumer or transaction, information specific to the consumer or transaction that the creditor relied upon when providing the LE and that is inaccurate or changed after disclosures were provided, or a new information specific to the consumer or transaction that the creditor did not rely upon when providing the LE. When an LE is issued, the creditor is presumed to have known all services involved with the transaction and cannot claim a change of circumstance if the information was inaccurately disclosed, if we just made a mistake. For example, if the creditor inadvertently left off a credit report fee, and we know a credit report is required for this transaction, and that error is noticed during the processing of the loan, this omitted fee cannot be the basis of a change of circumstance, allowing the reissuance of an LE with a reset of the tolerance basis. Some examples of a change of circumstance could be a national disaster, such as a hurricane or earthquake, which damages the property or otherwise, and that results in additional costs to the consumer. Maybe the title insurer goes out of business during underwriting, and now we need a new title company and all of its services. Or new information relied upon when providing the LE is discovered, such as a cloud on title. That's going to affect our recording fees. And of course, we have when the loan is locked after the initial LE is provided. When talking about the change of circumstance and reissuing an LE, a few things to remember are outlined on this next slide. First, the timing of reissuing the LE. We need to do that within 3 business days of the change of circumstance. And Brad's already covered what the definition of business day is for the LE. Secondly, we must document the change of circumstance clearly in our loan file. We want to document what changed, such as the loan was locked, to what extent the change impacted costs. Maybe the loan was locked and then the loan level pricing adjustments are now $1,000 from $500 as originally disclosed. And it's always a good idea to document that data change. This will clearly support that the LE was reissued timely. Now, when reissuing the LE, a creditor should update all fees at the time it's reissued and base all of these fees on what is reasonably known at the time of issuance. If we use our example of reissuing a LE for a rate lock, and we know we're changing the loan level pricing adjustments from $500 to $1,000, we also could have received the homeowner's insurance from the agent. If we did, we would want to update the prepaids and initial escrow deposits section as applicable using the new premium amount we just received from the agent. Or maybe we have received the appraisal already, and that invoice is only $400 from the $500 that we originally disclosed on the initial LE. We would want to update every one of these fees on the reissued LE since this is the information that's reasonably known to us at the time. Service provider list. On the next few slides, we will discuss the service provider list. A few things to remember regarding the service provider list is outlined on this slide. Services on the service provider list should be those services required by the creditor for which the borrower was permitted to shop. Basically, Section C of the LE. It must include at least one provider for each service listed. We must provide adequate information for each provider to adequately allow the consumer to shop. So at a minimum, we want to make sure we're disclosing the name of the provider, their address, phone number. Our consumers should be able to contact them to get costs and shop for those costs and services you have on the list. And we must include a provider that can actually perform the service for the property location. For example, if we have a borrower that's purchasing a second home in Florida and we use a local title company in our area, not a national title company now, but a title company that's just down the street from our branch on the actual service provider list, if that borrower would call that local title company and try to obtain the fees and services for a home located in Florida, they would not be able to obtain that information. Therefore, we're not allowing them to shop. One of the common errors we see on the service provider list is we have a service that's required by the lender and we disclose it in Section C of the LE, allowing our borrower to shop, but we completely leave off that service from our service provider list. As an example, let's say a creditor knows they will not be closing a loan. the title company is definitely going to close this transaction for us. And accordingly, we've disclosed a $250 closing fee on the LE in Section C. However, our service provider list did not include the closing fee as a service on the list, so we really didn't allow them to shop. That $250 closing fee now cannot be used in the aggregate calculation for the basis of tolerance cure allowances. We must first omit that $250 from the aggregate 10% amount when calculating what was originally disclosed to the consumer. Now let's move on to the closing disclosure and some timing requirements. When providing the initial CD, the consumer must receive the CD at least 3 business days prior to consummation. Now, again, Brad has already described and given us the definition of that business day. Now, the mailbox rule does apply. That is, the CD is considered received 3 business days after placing in the mail or providing the CD electronically. Now, we can obtain a confirmation of receipt, such as if the CD was emailed today to our consumer and we receive an email tomorrow from the consumer stating they've received the CD would be considered received tomorrow without having to apply the mailbox rule. The waiting period can be waived for a bona fide personal financial emergency, such as our home is going to be foreclosed upon if the refinance does not close today so I can get the funds before it's foreclosed on. Now, when we think about redisclosure and the triggering of a new waiting period, we can use the initial CD to set tolerances for those increases which involve a valid and documented change of circumstance. So there's no need to delay the closing. In fact, that would not be in the consumer's best interest. We do not need to reset the 3-day waiting period when we're simply resetting tolerances on fees. There are a few instances, though, in which that additional 3-day waiting period is triggered, such as a reissued CD adding a prepayment penalty, the APR is no longer accurate under the rule on a reissued CD, or the loan product changed. We do not typically see the addition of a prepayment penalty or a loan product change so far into the game, but that inaccurate APR has thrown us for a loop, I'm sure, a time or two. Let's move on to the closing disclosure content and some technical errors. One of the more tricky and complex issues we commonly see during reviews is the appropriate use of Appendix D. Appendix D is that methodology used on those closed-end, multiple advance transactions, such as a construction loan. Appendix D is used when the amounts and timing of advances are unknown at consummation for a construction phase only, and it assumes 1/2 of the commitment amount is outstanding for various calculations on the TRID documents. An example of when Appendix D would be appropriate would be for, let's say, a $100,000 construction loan, when all the funds are being held in escrow for future disbursement. Now, at consummation, we don't know when those advances are going to be made. We don't know how much those advances are. So since all that information is unknown, we may use the application of Appendix D. Now, this next slide illustrates the values on the CD that would be understated or overstated when Appendix D is not used appropriately. So we're talking about monthly payment, projected payments, our total payments, finance charge, annual percentage rate, and total interest payment. An example of an inappropriate use of Appendix D would be if we have that $100,000 loan, this time closed-end multiple advance loan, to refinance the current mortgage and allow for some funds for future advances to improve the property. $75,000 in my example is used to satisfy and replace the existing lien, and the remaining $25,000 would be held for future advances to improve the property. Now, at consummation, we know that 75% of the funds are going to be known to be advanced day one. If we base all of these calculations and values shown on this slide on only $50,000 or half of the total loan amount, Several of these values will be underdisclosed and understated, and that could be interpreted by a consumer as being unclear, such as monthly payment. A payment based on $50,000 in our example and disclosed on the CD would be a lot less than the first payment they are going to be required to make at $75,000, which we know is already advanced again day one. We just need to think sometimes when we prepare these documents, what is most clear and beneficial to our consumers? Seller's transaction charges. These are the seller paid charges that are in connection with their portion of the transaction. We must include all seller paid services in connection with the seller's portion of the transaction on the buyer's CD, such as real estate commissions, inspections, warranties, even the closing fee for the seller's side of the transaction. The rule only allows for the omission of information from the seller's summaries of transactions table, which is sections M and N on the third page of the CD. This is the section that would show the payoff of the seller's current lien on the property. All other seller information is required to be disclosed to the buyer. Now, the intent of this rule was to make the full cost of such a transaction as transparent to the consumer as possible. An issue I know every creditor has run into is when the title company does not have all of the seller information available to us when the creditor is responsible for providing the CD to adhere to the timing requirements. There are a few things that you can do. Our suggestion would be to first disclose what is reasonably known, such as the proration of taxes. We're able to calculate those proration of taxes and disclose it on our CD based on the closing date, at least a reasonable close estimate. Also, document in your loan file your attempt at obtaining the seller information. Document who you spoke to and when, and that the information was just not yet available. Then redisclose all the fees paid by the seller for their portion of the transaction, once available from the title company, on a revised CD prior to consummation. If you follow these steps, it should be clearly documented that you performed your required due diligence. Separately itemize all title services. We may not lump together title services. The CD should follow title invoice or the title company's Alta settlement statement for fees. We are still seeing in some instances where the services performed by the title company disclosed on the CD in either sections B or C are being lumped together. For example, if we have an invoice in the file that shows separate costs for an exam fee, search fee, title services fee, and maybe an endorsement fee, we should not see the CD disclose all of those fees lumped together as one fee labeled title services fee. We need to be sure that the CD follows the exact fees and services as the title company has referred to them, again, for the intent of transparency. The contact information table. Two important factors to think about for the contact information table. Number one, it should be complete. And number two, the information should be accurate. There's nothing really profound here, but we are still identifying some missing or inaccurate information. When preparing the CD, we have a few tips for you. Be sure to check your real estate broker information and be sure all applicable information is disclosed and accurate. Check your NMLS ID numbers. Make sure those are accurate and they're being disclosed in the right fields. Check your settlement agent and settlement agent contact information. One of the most common findings we see is that if the bank is closing the loan and they're handling all the disbursements on the loan, then the bank is actually acting as a settlement agent and should be disclosed in this field as well. The consumer should be able to contact all the relevant parties from the information that's gathered here on this one table. We wanted to take some time on the next few slides actually, and discuss ARMs and the fully indexed rate concept. Now this slide describes how to calculate the fully indexed rate. A fully indexed rate equals the index value plus margin that you'll find on your note, and you will apply any applicable rounding factors, such as rounded to the nearest eighth. Again, this is also found and dictated on your note. The next slide is a good example of the calculation using a most recent 1-year Treasury index adjusted to a constant maturity. So we have an index of 5.44%. We're adding our 3% margin, again, found on your note. That gives us 8.44%. But now we have to apply the rounding factor to the nearest eighth, again, per your note. And we have a fully indexed rate of 8.5%. Now, why is the fully indexed rate important? Well, first of all, it determines whether the initial interest rate, your note rate, is at a discount or premium rate. A discount would be an initial rate that's less than the fully indexed rate, and a premium rate would be an initial rate that is more than the fully indexed rate. And then this will determine whether or not what the payment stream will be after your initial payment stream. Now, in the event the initial note rate is a fully indexed rate, there will only be one payment stream for the life of the loan. The fully indexed rate, which is the initial note rate, would be used. What do I mean by these different payment streams? Well, if we have a discounted or premium initial note rate, then our first payment stream will be that initial note rate, discounted or premium. And the second payment stream will be a fully indexed rate. Here's an example so that you can better get an idea of what I mean by these payment streams. If we have a 10-1 ARM with a 30-year amortization, an initial note rate of 7%, and the fully indexed rate is 8.5%. So at 7%, we have a discounted initial rate. The first payment stream would be 120 payments at the 7%, and our second payment stream would then be the remaining 240 payments at the fully indexed rate of 8.5%. Now, if the fully indexed rate is not used in the second payment stream, when we do have a discounted or premium initial rate, we have some calculations on our CD that would be gravely affected. Those are shown here on the slide. Their total payments, finance charge, our APR, and total interest payment. This oversight could leave your institution open for some large potential regulatory reimbursements to the consumer. This is why it's very important to determine whether you have a discounted or premium initial note rate and calculate that fully indexed rate accurately. Ladies and gentlemen, we have reached the end of our topics for today. We have discussed timing and content errors on the LE and CD, tolerance implications, change in circumstance, some errors regarding the service provider lists, as well as some information for the use of Appendix D and the fully indexed rate concept for adjustable rate mortgages. We hope you take this information back to your institution and apply some of these tips to your TRID loans today. I'm going to turn it back over to Brad for some resources and final thoughts. Brad, back to you.
All right, thanks, Sadie. Very, very nice job as usual. So this last bit of information will be short and sweet, I promise. So here we just want to leave you with a couple of links to resources. So try this and see if it works. It worked when we practiced it. I don't know if it will now or not. But hover over these links and see if it takes you right to the website. If it doesn't work, the link should be live in the slide deck that accompanied the recording. But I thought that was a neat little feature. So the first link is a page on the CFPB's website that has everything TRID related. It's got the reg itself, a compliance guide, sample forms, on and on and on. The second is a Fed website where you can look up many of the common index values that are used in mortgage lending, so you can test to see if your disclosures are correctly reflecting a fully indexed, discounted, or premium rate, like Sadie just discussed. So we'll close with a couple of slides that have contact information for Sadie and myself. As always, feel free to be in touch with either of us at any time. We've had a pretty good response to these sessions, so far, so we do plan to continue them on about a quarterly basis going forward. I know that several of you have been with us for all 3 of these webinars, We appreciate you hanging in there while we try out something new, try to get a little better at it each time. As I said at the beginning, we'll have some type of content coming out on CRA modernization reg. We'll also jump back into the 1071 game once we get a clearer picture on what the future holds for that rule. And at some point, we should know about the direct impact the beneficial ownership changes will have on financial institutions. It will also keep our ear to the ground about other topics that are of interest to you. We might even throw something in that kind of blurs the line between compliance and safety and soundness, like loan to value rules. So stay tuned with that. So with that, our regularly scheduled quarterly webinars for 2023 have concluded. We thank you for spending part of your day with us and hope to see you back again in 2024. Goodbye.